Thursday, June 16th, 2022, Maneco 64, home of alternative economics and contrarian views. So we're going to look at the markets, the Fed, what I think is going to happen in the next few years. And we're going to look back to the 1970s because I think the environment is very much like the 1970s. Stagflation, of course. So we're going to look how the Fed and Mr. Powell have made sure that gold and silver and commodities, for that matter, will perform very well in the coming stagflation. Before I start, I'd like to thank all the viewers, all the new viewers as well, and subscribers. We've reached 63,000. Every 1,000 is a good thing, of course. And yeah, thank you all for the support of the channel. A lot of you help with your comments, give me feedback, sometimes even send me things through Patreon, links and stories, which help me prepare the content. Also, thank you for your support through the super thanks, through PayPal and Patreon. Yes, yeah, we need to keep going. The channel, of course, our objective is to try to show people that there's a better way than the Keynesian way of big government, of inflationary fiat currencies. There is a way of sound money, small government, and self-reliance. That's what we try to do on this channel, with a bit of market and economic analysis as well. So that's what we're going to look at today. So let's start with the 70s, because I think we are in an environment that's very much like the 1970s. And I would say it's even worse than the 1970s because the world is awash in so much more debt. We've had 5 decades of fiat currency, under which debt and credit has been really readily available, and that's built up. Of course, unless you pay the debt off or write it off or default on it, it's still going to be there. And a lot of the big debtors, the people who borrow a lot, they have to keep borrowing because they can't pay it off, i.e. Uncle Sam or the UK government, any government, or even big corporations, even individuals who take on big mortgages and keep rolling it over. And the worst of all are people who are servicing only interest only and don't pay down the capital of the debt. And that's what the United States government is doing, and the UK government, all the European governments, Italy, Greece. They're on an interest only scheme, and it's a lot worse than the 70s, of course. So let's look at what happened in the 70s, which was a period of high inflation like we have now. Of course, Mr. Powell and his cohorts at the central banks are going to tell you that it's all under control. They're going to raise rates aggressively and everything's going to be okay in a couple of years. But look what happened in the 70s here. So they kept rates very low in the early 70s, or relatively low, as you can see here. 1970 to 72 was under 5%. Of course, Nixon didn't want high rates, and is one of the reasons why he closed the gold window. But then inflation reared its head, and the Fed funds had to be raised again. People go on about that Volcker did it. But look at in 1970, from 1972 to 1974, the Fed funds rate was increased from 3.3 to almost 13%. So it wasn't just Volcker that was trying it out. And then, of course, afterwards, they thought everything was fine and rates went down again towards 5%. And then inflation started picking up again. And as you can see here, we went from below 5 all the way to almost 20%. I think the high was in January 1981 at 19%. And Paul Volcker only took over around 1979. So you can see that it wasn't just Paul Volcker. Paul Volcker did the final big increase towards 19%, but it wasn't anything new. So keep this in mind, because now we're going to look at gold and silver back in the 70s, what they did, and the reason why commodities are the best place to be in a stagflationary environment. I think it was Janet Yellen. No, it was Ben Bernanke wrote an editorial the other day for the New York Times saying, oh, this time we won't get stagflation because central bankers have credibility. We fought inflation really well for the last few decades, so markets trust the Fed. I mean, it's another piece of what Mervyn King, who was the former Bank of England governor. He was the governor during the '08 crisis. And I give him credit for that. He's criticized people like Bernanke and others who think just because they have credibility, inflation won't go up. He said this is the King Canute theory of inflation. Just because you say so, it won't happen, right? So let's look at gold in the 70s. So yeah, we started the decade at $35 an ounce in the international markets because gold couldn't be traded as a monetary asset in the US up until January 1st, 1975. But the gold price was set mainly in the international markets in London. So 35, and then we rose to 200 by the end of 74. Yes, it did a big correction, almost a 50% correction there. It bottomed in 1976, just above 100. But look how gold went up in the period where the Fed funds rate went from 5% to almost 20%. Well, gold followed. Yes, it topped eventually when the economy actually went into a double dip recession, and Volcker really put his foot on the brake. Gold and silver eventually topped. But notice as well that period where the Fed funds went from around 3 or 4% to 12 in the first half of the 70s, gold also went up. So for all those people who think gold and silver and commodities are not going to do well in this tightening environment, I mean, think again. I'm not saying it's going to happen exactly, but it's a good idea of what's going to be going on, in my opinion. And the same thing for silver. There you go. This is a silver chart from the 70s and up until the early 80s. And what about the reaction of the markets yesterday? To be honest, what did I do yesterday? Did I sit here and watch the markets and listen to Powell? Sometimes I do, but yesterday was a day where we play golf at my club. In the evening, we play 9 holes. It's a little summer competition, so I went to play golf. And when I came home, I looked at everything and I noticed that the old saying applied: sell the rumor, buy the fact. That's what happened. So we had a lot of selling going into the FOMC the previous few days. People sold stocks, sold bonds, sold commodities. And then the Fed did what most people thought, the 3/4 rate hike, and the markets rallied. So sell the rumor, buy the fact. That's what happened. I think the hope of Wall Street and the people who still think inflation is just a a temporary, relatively temporary thing that the central banks have it under control. They're hoping now that the longer term yields are going to come down because they think the Fed's going to be tough on inflation. And we're going to get an inverted yield curve. We're going to get a slowdown. But I don't think the curve is going to invert. We're going to keep seeing yields go up all throughout the curve. You might get a little inversion, but it's going to be at a much higher rate. You could get 10% 2-year yield and 9% 10-year yield. So those people who think it's safe to park their funds in longer term treasuries and bonds, I think they're going to have a shock in the coming years. That's how I see it. The stock market as well, as we know, from 1966 to 1982 or thereabouts, didn't go anywhere in nominal terms. In real terms, of course, it lost a lot because the currency was debased. What's currency debased? Well, it's inflation. And inflation, of course, is not when prices go up. Inflation is when the government and the central bank borrow and spend. How does the central bank do it? Well, the central bank is the financing arm of the government. And I think it's going to get worse because foreigners are trying to diversify away from the US dollar because the United States has been using the dollar as a political weapon even before this year with sanctions on countries that they didn't like the way those countries acted. And I noticed yesterday that Tavi Costa, who's a great macro analyst from Crest Capital, he put this out here. Meanwhile, China continues to dump U.S. Treasuries. Their holdings just reached a new decade lows. China U.S. Treasury holdings. So there you go, and that's going to continue. That's going to mean that there's going to be less buyers of Treasuries. Of course, the Federal Reserve is expected to sell a lot of Treasuries. Their program of quantitative tightening, that's not going to help either. And that's going to create even more problems with liquidity in the markets. And when there's not as much liquidity, even in treasuries, financial markets become very volatile and uncertain. And what's the best thing really to have, in my opinion, in uncertain markets? Well, a hard asset. Or hard assets like gold, silver, and commodities. And that's another reason why I think they're going to continue to do well in these stagflationary times. So the FT reported last night about this, and I'm going to read from this article. It says, and this is quoting someone here, someone called Swiber. Our understanding is that the Fed's involvement in the market buying treasury securities helps improve liquidity, helps improve market functioning, said Swiber. And now we're going to be in an environment where there's more supply that needs to be taken down, and the Fed is not there to help. Well, not even the Chinese look like they don't want to help either. And others, I would say, they're buying gold instead. That means that the size and frequency of price swings may worsen as the Fed withdraws from the market, particularly in the Treasury market, where the central bank has had the biggest presence. But because the Treasury market is the backbone of all U.S. financial markets, those effects ripple out. And I would add the world's financial markets, not just the U.S. Liquidity in the treasury market in recent weeks has been at its worst levels since March 2020, in the days before the Fed was forced to intervene and buy bonds to ease market functioning. According to a Bloomberg index that measures traders' abilities to execute deals without affecting prices. So right now, I'm giving the Fed the benefit of the doubt that they're gonna be able to implement this relatively tight monetary policy for the years to come. But who's to say that we couldn't have another emergency like March 2020? And that's, again, another reason to hold on to your physical gold and silver, to your commodities, I would say. So with that, let's quickly look at where the markets are this morning. It's 7:41 a.m. London time. We got spot gold at 1830.50. It's down about $3. High's been 36, low 29.50. So we're near the lows. Spot silver 21.60, down 6 cents. Excuse me. Range has been 77 to 58. So right near the lows here, overnight lows in the metals. The Dow future is down 280 points. So just under 1%. NASDAQ 100 future is down 1.4%. And the S&P 500 future is down just over 1% at 37.48. The FTSE index is down 50 points. And the Euro Stoxx 50 is down 20. To the currencies now, we've got sterling down almost 0.5% at 121.27. We got the euro down 1/4 at 104.15. So yes, the currencies rallied yesterday as well after the Fed. So the dollar dropped. And we're seeing now that things are going back down a little bit. And I think that will be the overall trend going forward, especially for stocks and and bonds for that matter. The dollar is up 0.4% versus the yen at 134.40. And the dollar is up 1/3 versus the Swiss franc at 99.77. Dollar's up 2/3% versus the yuan at 6.71. Check out the ruble. The dollar is at 57, really, around 57 versus the ruble, which is fairly steady. I think yesterday we were around 56. To the other currencies now, we've got Aussie dollar down 1/3 at 69.80. The dollar's up 1/4% versus the Canadian dollar, 129.25. And the Kiwi dollar is down 0.5%, 62.60. General commodities, WTI crude is off quite a bit since the beginning of the week. Still above 100, of course. It's up 0.8% at 114.02. Brent crude is up 0.75% at 117.60. And high-grade copper is up 0.2% at 418. And U.S. nat gas is up 1.6% at 754. To finish off, we'll look at the 10-year yield and the yield curve, or the bond market, U.S. Treasuries. 10-year yield is at 332. So, yeah, yields have come off. I think we got to 350 the day before the FOMC. And now we're at 332. We're down about 7.5 basis points. So why would people buy long-term bonds if the Fed is hiking and is going to do a quantitative tightening? Well, because they think by being quite tough in tightening, the Fed will damp down long-term inflationary pressures, and they feel more comfortable in buying longer-term bonds or treasuries. But as I said, I think they're mistaken to that, because I think the whole curve, all yields are going to keep going up. And yes, we might see inversion, but I expect them all to keep going up. The 2-year yield is down just 2 basis points, so not down as much, and is at 326. So we're not inverted. There's about 6 basis points positive difference right now. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And yes, I wish you all a great rest of the day. Take care. Bye.